Decentralized Finance, or DeFi, is an umbrella name for a variety of financial solutions based on cryptocurrencies or blockchain that aim to eliminate financial intermediaries. DeFi inspired by blockchain, that technology that underpins the digital currency Bitcoin. Blockchain allows several organizations to keep a copy of a transaction history, ensuring it's not controlled by a single central source. In this video, I'm going to explain to you what is DeFi. Now let's get into it. Ethereum Applications. The majority of DeFi applications are developed on Ethereum, the world's second largest cryptocurrency platform, which differs from Bitcoin in that it's easier to use, build different types of decentralized applications beyond basic transactions. These more complex financial use cases are originally mentioned in the first Ethereum white paper by Ethereum founder Vitalik Buterin back in 2013. That's because Ethereum smart contract technology, which executes transactions automatically, its specific criteria are satisfied. Provides a lot more freedom, solidity, and Ethereum programming language. Is specifically built for generating and deploying smart contracts. Let's imagine a user wants money delivered to a friend next Tuesday, but only if the temperature rises beyond 90 degrees Fahrenheit, as predicted by weather.com. Smart contract can be used to write such rules. The following are some of the most popular applications of DeFi. Number 1. Decentralized exchanges, DEX. DEX allows users to swap one currency for another, such as US dollar for Bitcoin, or Ether for DAI. DEX are a popular sort of exchange that links users directly so they can direct cryptocurrencies without entrusting their funds to an intermediary. Number 2. Stablecoins, a cryptocurrency that is linked to a non-cryptocurrency asset, such as a dollar or euro, in order to keep its price stable. Number 3. Lending platforms. These platforms employ smart contracts to eliminate the need for middlemen such as banks to manage lending. Number 4. Wrapped Bitcoins, WBTC. A method of transferring Bitcoin to Ethereum network, so it can be utilized in Ethereum's DeFi mechanism directly. WBTCs allow users to earn interest on Bitcoin they lend out through the above-mentioned decentralized lending networks. Number 5. Prediction markets. This is where people can gamble on the result of future events, such as elections. The purpose of DeFi version of prediction markets is to provide the same functionality as traditional prediction markets, but without the need for middlemen. Number 6. Yield farming. For experienced traders prepared to take a chance, yield farming is a method of shifting through numerous DeFi tokens in search of higher returning prospects. When DeFi programs recruit users to their network by giving them free tokens, this is known as liquidity mining. This has been the most talked about method of yield farming so far. Number 7. Composability. DeFi apps are open source, which means anyone may look at a code underlying them. As a result, using the code as building blocks, these apps can be used to assemble new apps. Number 8. Money Legos. To put the concept of composability another way, DeFi apps are similar to Legos, the toy bricks that children click together to build buildings, automobiles, and other structures. To create new financial solutions, DeFi apps can be snapped together like money Legos. Lending platforms. Lending markets are a prominent type of DeFi that connects borrowers with cryptocurrency lenders. Users can borrow cryptocurrency or provide their own loans on Compound, a popular website. Users can earn money by lending out their money and earning interest. Compound uses an algorithm to establish interest rates, so if it's a stronger demand for a cryptocurrency, the interest rates will rise. DeFi lending is collateral based, which means in order to get a loan, a user must put up collateral, which is frequently either the Ethereum token. That means users don't have to reveal their identity or credit score in order to get a loan, which is how traditional non-DeFi loans work. Stablecoins. Stablecoins are another variant of DeFi. Cryptocurrency have more volatile prices than fiat currencies, which isn't ideal for those who want to know how much their money is worth in a week. Stablecoins bind cryptocurrencies to non-cryptocurrencies, such as US dollars, to keep price stable. Stablecoins attempt to provide price stability, as their name suggests. Prediction markets. A so-called prediction market is where users wager on the outcome of some event, such as will Donald Trump win the 2020 presidential election. It is one of the oldest DeFi apps running on Ethereum. Participants' primary purpose is to make money. While predicting markets can sometimes outperform traditional approaches, such as polling and predicting outcomes, InTrade and Predicate are two centralized prediction markets with an excellent track record in this area. Because prediction markets are traditionally frowned upon by governments and frequently shut down with administration in a centralized fashion, DeFi has the potential to increase interest in them. DeFi frequently asks questions. How do you make money with DeFi? The value of Ethereum DeFi projects has skyrocketed With many users allegedly profiting handsomely. Users can produce passive income by loaning out their money and earning interest via Ethereum-based lending apps. As indicated above, yield farming, as previously mentioned, offers a potential for even high profits, but it also comes with a higher risk. It allows users to take use of DeFi's lending capabilities to put their crypto assets to work for the best potential profits. These systems, on the other hand, are often complex and opaque. Is DeFi safe? DeFi is great for people who already have experience in crypto. Many people believe that DeFi is the way of the future in finance, and the investing in the disruptive technology early on might pay off spectacularly. And yes, investors have potential to lose their entire investment. There are numerous hazards linked with DeFi. Bugs in smart contracts, developer oversights, flash loan assaults, rug pulls, and scammers are just a few of the possible threats. Newcomers, on the other hand, may find it difficult to distinguish between good and terrible projects. There has also been a lot of bad ones. Many DeFi applications such as meme coin Yam have crashed and burned as DeFi activity and popularity has surged through 2020, bringing the market capitalization from 60 million to zero in 35 minutes. Other DeFi businesses such as hot dog and pizza suffered the same fate, with many investors losing a significant amount of money. Furthermore, DeFi problems are still a prevalent occurrence. Smart contracts are strong, but once the rules are banked into the protocol, they can't be modified, which means faults are typically permanent, increasing risk. Will DeFi go mainstream? While more individuals are becoming interested in DeFi application, it's difficult to predict whether they'll go. Much of this is contingent on who and why they are beneficial. Many people feel that various DeFi projects have the potential to become the next Robinhood, attracting hordes of new users by making financial apps more inclusive and accessible to individuals who previously haven't had access to them. This financial technology is new and experimental, and it has flaws, particularly in terms of security and scalability. These issues are expected to be resolved in the future. According to the developers, sharding, a method of separating their underlying database into smaller portions that are more manageable for individual users to execute, could help Ethereum 2.0 address scalability difficulties. Will Ethereum 2.0 affect DeFi? The emergence of Decentralized Finance DeFi, and soon to be released ETH 2.0, will allow investors to earn additional return on top of any capital gains. Additionally, users hold ETH directly through DeFi lending methods may be eligible for some tax benefits. Ethereum 2.0 isn't the complete solution of DeFi's problems, but it's a start. Other protocols such as Radiant and TrueBit are being developed to address Ethereum's scaling problems. Ethereum's DeFi experience have a stronger chance of becoming real goods, possibly even mainstream, if and when the solutions are implemented. Bitcoin as DeFi? While Ethereum reigns supreme in the DeFi realm, many Bitcoin proponents share the objective of eliminating the more intermediary and most sophisticated financial transactions, and they've devised ways to achieve so using the Bitcoin protocol. DG Labs and SureBids, for example, are developing a Bitcoin DeFi solution called Discrete Log Contracts, DLCs. With the use of Bitcoin, DLC provides a mechanism to execute more complicated financial transactions, such as derivatives. One application of the DLC is to pay someone Bitcoin only if certain future conditions are met, such as if the Chicago White Sox win their next baseball game. The money would be distributed to the winner. Do you think that DeFi will start to be relevant in the future? Let us know in the comment section below. And hey, if you enjoyed the video, don't forget to like our video so we can continue giving you the best content here in YouTube. Thanks for watching. See you in the next video.